Bitcoin, it's not doing anything actively in order to minimize its volatility. Our goal is to do better than Bitcoin on that front.
Why does Pinto continue to trade below $1?
Pinto is willing to accept significant amounts of volatility in the short term in order to achieve long-term sustainability. If the volatility of Pinto can be sufficiently low that Pinto can start to find product market fit as a competitor to USDC and USDT.
Can an algorithmic stablecoin work, and why?
This is a great question. So
previously, in crypto, we've really tried to make these algorithmic stablecoins work. I don't know if you guys necessarily classify yourselves as an algorithmic stablecoin still. However, you guys are still pursuing the goal. Can an algorithmic stablecoin work, and if so, why?
This is a tremendous question, and one that I think requires a lot of nuance to do justice. So the algo part, I think we're all on the same page about. Like, can we encode logic that under certain conditions, the system will respond to those conditions in an autonomous fashion? Algo part, I think we're all pretty clear about. Can we create an algorithm that's trustless, that does something to create, in this case, where I think the rubber meets the road, if you will, is stable. What do we mean by stable? And the Pinto, we've tried very actively to move away from the term stablecoin in general, and instead are presenting low volatility money. So instead of a stable coin, we are trying to advocate to change the lexicon and change the dialogue around algo stables to creating an algorithmic low volatility money. And the nuance, I think, comes when the question is asked, what do you mean by stability, right? So stable, particularly the centralized stable coins that everyone knows and loves today, and I say that a little tongue-in-cheek when it comes to the love part of USDC and USDT, these are collateralized by effectively a risk-free representation of the thing that they are supposed to represent. So USDC and USDT basically hold portfolios of risk-free US government debt that is ultimately redeemable for the US dollars that they're supposed to represent. So when it comes to volatility, it's very rare for these stable coins to experience effectively any volatility whatsoever. And if you were going to measure price volatility for USD or US government treasuries collateralized stable coins, the volatility has to be measured in basis points. And the industry has gotten quite used to that level of stability. And with good reason. Modern economies run on stable assets, or we would say they run on low volatility assets, where if you think about the value of the US dollar over time, it's actually not perfectly stable.
Right.
It actually does have volatility. There's inflation, there's changes in the value of the US dollar over time, certainly, but the US dollar is the most low volatile and scalable asset that the economy has to date. And that is a large part of the reason for its success historically. And so where the crypto economy has had a significant amount of friction is trying to compete with the USD denominated economy, right? Where the global economy has access to this super low volatility asset compared to all the assets that came before it, even if it's not perfectly stable. And through that low volatility or stability, if you really want to go there, there's a really strong economy built on it. And in particular, the reason why stability is so important is it allows for individuals to plan for the future. This is, in many ways, the big problem with Bitcoin. As amazing as Bitcoin is for storing value, our thesis is that a large part of the reason why there has not been a larger crypto economy that has sprung up that is able to compete with the US dollar denominated economy is because of the volatility of Bitcoin, that the excess volatility in the Bitcoin price makes it really hard for lenders and borrowers alike to plan for the future in a sustainable fashion, where so much economic value is created through entrepreneurs borrowing money at some interest rate on the thesis that they can create more value than they owe in interest payments. And as soon as you add the volatility of Bitcoin to those interest rates, you now decouple the actions of the borrowers and lenders from the success of the loans. And so this is a bit of a long-winded way to say that stability is sort of a false god, that the only time you're going to get stability is in reference to some other asset, and that's always going to come at the cost of other things. In the case of an algo stable, it comes in the sacrificing trust and sacrificing scalability. You have to trust some centralized custodian in order to custody the assets to really get down to zero volatility. And it doesn't scale to infinity because there's an increasing marginal cost for every extra dollar you want to lock up. Right. So what we learn from this dynamic is, well, if perfect stability is not possible, and in fact, the modern economy runs on a low volatility asset, the US dollar, maybe instead of creating or trying to create an algo stable, where an algorithm is trying to create something with perfect stability, we have a different perspective at this point, which is it possible for an algorithm to affect a currency in such a way where it is able to dampen the volatility of that currency sufficiently to create utility, right? It's a different framing of the problem. So instead of saying, can we create a perfect algorithm that creates perfect stability, instead it's a much softer problem of, can we create an algorithm that minimizes volatility enough or dampens volatility enough such that we can create some utility. So if you juxtapose what we're doing with Bitcoin, Bitcoin is maximum trustlessness, and from a monetary policy perspective, it has no opinions whatsoever. It doesn't affect volatility in any way, shape, or form. Bitcoin as a currency only cares about supply. It doesn't measure demand. It doesn't measure where the equilibrium is between supply and demand. It only cares about the supply of Bitcoin. And that supply schedule is effectively fixed, and there's only ever going to be 21 million Bitcoin. What we are doing with Pinto and what we are trying to accomplish through talking about this in the context of low volatility money as opposed to a stable coin is to reframe the problem in terms of, is there a way to have monetary policy that is based in an algorithm more sophisticated than the Bitcoin monetary policy algorithm that has the effect of dampening the volatility of the Pinto currency price enough such that there is some utility created?
Right. So I have a bit of a follow-up question here. A couple months ago, we interviewed Hasib of Dragonfly, and he talks about how in crypto there have been 3 places where real value has been created, where there have been like real, meaningful unicorn type outcomes, and that's at like the chain level, with exchanges, and then with stablecoins. You talk about something that's not quite a stablecoin as we think about stablecoin, like something that's always pegged to $1, but a lower volatility asset. Do you guys think it's true that this currency might be adopted in the same way that stablecoins are adopted, or does it kind of fit into a new category of like more stable assets?
It's a very interesting question to think about. I would say you also have to add money to the use cases that have found product market fit in our space. Right. Where I think Bitcoin is really the only one that has found that product market fit, and it's exclusively as a store of value. It hasn't really found product market fit as a medium of exchange or unit of account, where instead stable coins have really filled that gap to date. So if you think about economy, right? Economy is fundamentally defined by exchange, and exchanges are creating utility for their users by matching buyers and sellers and are able to extract some value for providing that service. So exchanges have found product market fit. You have chains on which these exchanges can run if you will. So the bedrock, the computational platform on which people can express themselves and these exchanges can perform matching, have also found product market fit. But I think maybe to combine like Bitcoin with stablecoins, I would say cryptocurrency, like money based on cryptographic primitives and crypto economic incentives, is the other class of things that have found product market fit. And then it's like, well, you have two sides of this coin, pun intended, where you have Bitcoin, which is trustless but highly volatile, filling the store of value. But then on the other end, you have medium of exchange and unit of account, which has so far been filled with zero volatility but tremendous trust. And so in many ways, we identify this as a whole. Like clearly, we have these censorship-resistant, permissionless, trustless networks, computer networks, which are becoming more and more performant. We have exchanges, which from where we sit, honestly still suck. Like the DEX game has not reached the level that we would like to see it at yet. We have a lot more to say about that, but maybe that's a conversation for another day. But the point is, the DEXs have found at least some product market fit, being a place where price discovery can happen and value can be traded on these chains. But in terms of the value that's actually being exchanged, you obviously have Bitcoin, which is in a sort of a league of its own in terms of currency, but most exchange, right? You talk about utility of money, store value, medium of exchange, unit of account. The medium of exchange is something you want to be relatively low volatility. Mm-hmm. And we were just talking about for unit of account, particularly for borrowing and lending, that's also something you need to be really low volatility. So I think to answer your question directly, on the one hand, Pinto is trying to fill like a new space in the design space of money where it's not perfectly trustless at this point. Like there is, first and foremost, some external value index where the Pinto price is targeting the value of a US dollar. So already there's some external source of what is a value index that we want to use, which you could say that's trusted just from the perspective of like the US government could destroy the value of the US dollar. And if Pinto's trying to follow the value of the US dollar, that would also have negative effects on Pinto. So it's not like we have some trustless value index that will allow the system to run itself totally in a vacuum, whereas Bitcoin does have that beautiful property. And furthermore, like the current state of oracles are such that the oracles where the external value of Pinto is coming from not totally trustless oracles. Chainlink just isn't at that point at the moment. So there are points of trust where we can't say that Pinto right now has the same level of trustlessness as Bitcoin, but it's way more trustless than something like USDC or USDT by orders of magnitude. And so if you think about like the spectrum where it's like you have volatility on one axis and trust on another axis, and you could maybe draw like a straight line along those two axes and say like, well, this seems to be like the design space of cryptocurrency today, where we have Bitcoin on one end, which is super low trust, super high volatility. And then we have like your algo stables of today, which are super high trust, super low in volatility. Pinto is trying to do something in the middle from this perspective, where it is significantly lower trust, much closer to Bitcoin on the trust axis, but significantly lower volatility than Bitcoin, much closer to the stable coins on the stability axis. So from that perspective, you could say this is a new thing. But on the other end, if you go back to this, like responding to the Haseeb framework directly, and we see it as like you have your chains, which is your compute, you have your exchanges, which is the thing matching people, and then you have a currency that people are using to perform all these exchanges. In that sense, we are trying to compete directly with USDC, USDT, and not carve out a new market. This is a direct alternative to that. And we have a thesis that if the volatility of Pinto can be sufficiently low, that it doesn't have to be zero volatility. It just has to be a sufficiently low level of volatility that Pinto can start to find product market fit as a competitor to USDC and USDT.
Okay. So we've gotten deep, or already into the deep end just after a few minutes of chatting, but I would love for you to from the highest, or from a very accessible level, explain the mechanism of Pinto and how your currency works?
Definitely. And appreciate, we're talking high level about what's going on, but it might be helpful to just contextualize the thing itself.
Right.
So there's an algo, and it's trying to create low volatility in the price of Pinto. Mm-hmm. Now, there's really, and it has the target price of Pinto is $1. So there's really two cases that the algorithm has to deal with in its most simplest form. One is the price is too high. The other is the price is too low. In the simplest terms, when the price is too high, things are pretty simple. The protocol can arbitrarily mint new Pinto and increase the supply until the equilibrium price, is at its value target. So if the Pinto price goes too high, the protocol can quite simply mint more Pinto, and through increasing the supply, basic supply and demand dynamics, you increase the supply, you expect the price to go down if demand stays the same. So this is the simple case, price too high. And there is a long history of algo stables that have quite easily been able to deal with the price too high case. Now, to go a little bit lower, and we don't have to get into how this is all achieved, there's an open question as to when the price gets too high. There's this positive feedback loop where price is too high, the thing is growing. That actually attracts more demand. So it's not such a simple thing where you can just increase the supply and that doesn't have any effect on demand. These systems have high reflexivity. So increasing supply actually often increases demand, which means you have to increase supply more. It's not so simple to actually just increase supply. We can get as deep into that as you want if you're interested in spending the time that way. But for now, I think suffice to say, price too high, the algo increases supply. And the much harder case is price too low, where the people that are holding the currency are holding it for two reasons, most likely. One is that they find some utility in the low volatility nature of the currency. And the second is that when the price is too high, the seigniorage, the minting that occurs, is distributed to the holders of the currency. So it's like, well, I'm holding it, it's not so volatile, and I'm earning yield for holding it. That's a value proposition that some people say, okay, I'm going to hold this currency. However, when the volatility is realized, when it's manifest, when the price actually dips below the value target and the price starts to decrease, there's actually this negative feedback loop, and a highly reflexive one at that, where as the price decreases, the utility for holding the currency dries up, where on the one hand, there's no new Pinto being printed or minted when the price is too low, because obviously that would cause the price to go down further. So the yield dries up. And then separately, the decrease in the price of the currency makes it such that the underlying volatility that the holders are realizing also dries up or decreases. So when the price dips, there is very oftentimes a run on the bank, if you will, where everyone is trying to exit the system simultaneously. The people exiting the system lead the price to come down further, which leads more people to want to exit the system, and so on and so forth. And so in many ways, the history of algo stables can be understood from the perspective of how do each of these systems handle the downward price pressure, the bank run feedback loop. What are the mechanisms in place for the system to respond to that? So it's worth saying Pinto is downstream of all of those previous attempts, and the mechanism and how the system works when the price is below its value target is at this point layers and layers deep. And so maybe I'll just, per your request to make it accessible and keep it high level, just start at the top level of, at a very basic way, how the system responds to this circumstance and what tools it has available to it in order to minimize the downside volatility, ultimately end the bank run, and eventually return the price of Pinto to its value target, and then we can go as deep as you want after that. So what does the system do fundamentally? The protocol is credit-based. So the algorithm, there's an open question, like how, when the demand is drying up, when the price is dipping, how can the algorithm create new demand? How can the algorithm decrease the supply in order and increase demand in order to bring the equilibrium price back to its value target? So the way Pinto handles this is with credit. It tries to borrow from the market. So borrowing and credit are something that are super profound in nature. Credit is really powerful because of its own positive feedback loop. That if the algorithm is able to borrow enough Pinto from the market, and when it borrows Pinto from the market, it burns that Pinto. If the protocol is able to borrow enough Pinto from the market to decrease the supply enough and increase demand enough, because often in order for people to lend Pinto to the system, they have to buy the Pinto. So there's people come in and buy the Pinto, that increases demand. They lend the Pinto to the system itself. The system burns the Pinto, that decreases supply. So you can see how this has the property of increasing the price, assuming that the protocol is viewed as credit worthy, assuming that people are willing to lend Pinto to the protocol. It has the ability to increase the price and return it back to its value target. The fundamental question becomes, what is the credit worthiness of the protocol? And so credit has these really interesting properties where, one, if the protocol is able to borrow enough Pinto from the market in order to return the price to its value target over time, such that then in the future the price increases again, the supply increases, and with a portion of all of the mints, the protocol actually repays its debt. In the future, as the algorithm builds its own credit history, there is the hope and expectation that more people will be willing to lend more to the protocol at a lower interest rate. That as the protocol builds a history of paying back its creditors, that it's more likely that other people will be willing to lend to it in the future, that more people will be willing to lend more value to it in the future, and that more people will be willing to lend more value at lower interest rates. And so from each of these perspectives, credit has this incredible property where it can scale arbitrarily. We talk about the US dollar. There's trillions of dollars out there. It would be really, really hard to mint trillions of dollars of collateralized stablecoins. You'd have to buy a lot of treasuries in order to do that. And particularly if you're not going to pass on the yield from those treasuries to the holders, there's a lot of cost realized for locking up all of that value. In juxtaposition to those trusted stablecoins that scale to the hundreds of billions, but remains to be seen how they can scale to trillions or tens of trillions. Credit has this incredible property where it not only scales, but as it scales, it actually becomes more sustainable and more likely to be able to persist itself in perpetuity. And so the fundamental value proposition of Pinto, how does the algorithm work? How does the system create low volatility? The answer can quite simply be summarized as when the price is too low, the protocol tries to use its credit worthiness to borrow the excess supply from the market, burns that supply to remove it from the market, and thereby is able to decrease supply and increase demand in order to return the price of Pinto to its value target. Mm-hmm. So I know a bit of a long-winded answer there, but hopefully it's helpful.
Sure. So just to kind of review again from the highest level, we have two conditions. Well, we have a target price of $1 US dollar. And then we have two conditions. One is when the price is over $1, and when that happens, more Pinto is minted and returned to holders. And then in the circumstance where Pinto is below $1, then what the protocol does is borrows Pinto from Pinto holders, burns that to increase or to lower supply, and thus pull the value of Pinto back up to $1. And that's kind of like the highest level. Is that correct?
Yes.
Phenomenal. So a question here, like right now, Pinto's trading at 60 cents. So I guess when I think about this, it would be logical that when Pinto's trading below a certain price, then I can just continually raise the interest rate, and eventually there will be some market equilibrium where someone's going to say, okay, I'll take a bazillion percent interest in exchange to deposit to loan my money to the protocol, right? There's some, my conception will be that there's some market clearing rate. However, we've seen Pinto for most of its history trade below $1. Why, despite the fact that there should be some kind of market clearing rate, why does Pinto continue to trade below $1?
This is a great question. So you're totally right that there is an expectation that at some interest rate, the protocol could certainly attract someone to come lend it enough money to return the price to its value target such that it can work, if you will. And I put work in quotes there because if the interest rate is a bajillion, gazillion percent, then great, the protocol will be able to return its price to its value target this time, but next time it will probably not be able to because it will be burdened with so much debt history, which unless it grows to a gazillion supply or a gazillion market cap, it won't have been able to pay off its previous debt from the last cycle. It's likely to die immediately thereafter because it needs to find the next marginal lender every time. So this is where there's a direct trade-off space, which is, should the protocol prioritize? And this directly goes back to the idea of creating perfect stability. So there's a trade-off here where the protocol could just say it's willing to pay any interest rate in order to find a lender right now. It doesn't care what the interest rate is, but it's not comfortable with any amount of time spent away from its value target. And therefore it's going to pay a tremendous premium to attract a lender right now. That comes at the direct cost of, in the future, being able to attract the next lender, if you will. So where like a lot of these designs originally came from, one of the OG is Basis, which is from back in like the 2017-18 cycle. And that model basically we never got to see that model out in the wild. But what I suspect would have happened is, the way that system works is they basically, at every interval, would measure exactly how much the shortage of demand was in order to return the price to its value target. And then the protocol would host an auction where it basically said, I have to borrow right now under no matter the circumstance. I will pay an infinite percent if that's what it takes. And in that way, short term was prioritizing basically no volatility. So it was really going for almost perfect stability. But from where we sit, that comes at the cost of long-term sustainability. So, the question you ask of, Pinto's been spending most of its lifetime below its value target. We look at that and say, that's totally expected and arguably very healthy. When the price is above its value target, the system pretty quickly starts to print new supply. So you don't really expect the protocol to get stuck with the price above its value target for long periods of time because of how easy it is for the protocol to handle that case. You could make an argument that it's good to spend more time above its value target. The response to that would be just to mint less, if you will, when it's above the value target so the system can hang out there more. But that's upside volatility. The goal is to minimize volatility on both sides. So it's great. The upside volatility system can handle pretty well, but this leaves the downside volatility case. And you're totally right. In most of Pinto's history, it has spent most of its time below its value target. From where we sit, though, the question isn't, is it below its value target? That's normal. The question is, how far below its value target is it? And there's a big difference between being at 99.9 cents and being at 60 cents, right? So here now is where the trade-off space starts to become really interesting, where it's like, okay, if the protocol is at 99.9 cents, maybe it really doesn't care that much and it should raise the interest rate super slowly, because why would it pay a bajillion gazillion percent to go from 99.9 to $1 when it seems like that's going to very significantly hamper its future sustainability. Versus now you've seen like the past month, the price has been at 80 cents, 70 cents, now 60 cents. And the whole crypto market's been coming down. And in many ways, you could say this is a great opportunity for the protocol to strut its stuff and demonstrate its lower volatility than these other assets.
Right.
And that's totally right. So there's an opportunity cost here that the protocol is realizing through making this trade-off, right? It's not just should it pay a higher interest rate to have lower volatility. There's a direct creating that utility in practice effect here, where the system has a trade-off space from where we sit, which is long-term sustainability, short-term utility. So from where we sit, you look at empty set dollar, you look at DSD and all the ESD forks. Those protocols all suffered from the same trade-off where they made the wrong decision. They were all trading or making the trade that the algorithm would prefer to pay a premium on the interest rate. And the way they set their interest rate wasn't optimal. That's a whole separate conversation. But all of those systems were basically making the trade-off that it would rather overpay in order to minimize volatility as much as possible. Whereas Pinto makes a different trade-off. Pinto says it is going for long-term sustainability, and it is willing to accept significant amounts of volatility in the short term in order to achieve long-term sustainability. I think where it's most helpful to contextualize this is in the context of Bitcoin, right? So Bitcoin is a system that runs on an algorithm, but the algorithm is super simple. It's not doing anything actively in order to minimize its volatility. And you look at the long history of price action on Bitcoin, this is a system that has experienced many 80+% drawdowns in its history. And so I think where we need to set expectations is our goal is to do better than Bitcoin on that front. This is Pinto's first cycle. This is its first bear market. And so in many ways, you could look at 60 cents and say this is down 40% from its value target. This is a disaster. The system is not working. We look at it very differently and say, for a first cycle, for something with no track record, with no credit history, with no reason for people to believe it's going to work, a 40% drawdown sounds a lot better than an 80% drawdown. And even if the protocol has an 80% drawdown this time and goes down to 20 cents, we would not look at that and say the thing has failed. We would say, well, let's see if it is able to borrow enough to return its price to its value target. What happens next cycle? Maybe next cycle, if people see it go down to 20 cents and then come back to $1 and pay off some of its debt, maybe next time people will be willing to buy in at 40 cents instead of 20 cents. So at this point, we're very much in a price discovery phase, and the model has a very clear mandate based on the way that it's parameterized not to raise the interest rate on the borrow action too much too quickly, because the more it pays in terms of a premium to borrow right now, the harder it's going to be for the system to sustain itself in the long term.
So basically there's kind of this flexibility built in where we say, if we have to drift away from this target price for even a long period of time, we're okay with that, given that we will have to issue less debt.
Yeah,
right.
Something like that. It's unclear where in that trade-off space is optimal. This is a debate that is actively raging in the Pinto community, if you will. 60 cents really sucks, man. I thought 80 was going to be the low. Maybe the protocol should be, borrowing at a higher interest rate. And then there's another camp that says, no, the interest rate's already too high. There are other mechanisms in place that are secondary to the credit that can also be used to help with price stability or dampening volatility. We need to emphasize those mechanisms instead of taking on more debt. So there's a lot of different trade-offs that the protocol can make, but you're totally right. At a high level, that is the trade-off, like volatility versus debt.
And then there's also a reflexivity built in where every time the price falls to, let's say, 60 cents, then there's not only the protocol is acting in itself to get the price back to $1, but there's also money to be made when the price does arrive back to $1. So then there's this kind of self-enforcing cycle of kind of arbitrageurs that believe in the mechanism and its ability to bring price back eventually to $1.
Yeah, this is a really interesting element. I think this is anti-reflexive from the perspective of it's two things. There's two elements to it. One is the arbitrageurs that you highlighted, where it's like, well, I don't even need to believe that the protocol is going to return to $1. I just think it's going to return to 80 cents. So I'm happy to buy here at 60 and sell at 80. And in that way, it's like, well, I'm actually, making money. Glass half empty is that you're extracting value from the protocol because you're buying low and selling high and not actually holding long term. But it's like without that participant, the price may go down to 40 cents, if you will. Mm-hmm. So there is utility actually created even by the arbitrager, and the protocol does offer a way for that arbitrager to make money through contributing to price stability, even independent of like the debt system, which is super cool. But then there's this other element, which I think is also really powerful, which is the protocol only repays debt when the price is at $1 or above, right? When the protocol mints new currency.
Right.
And so, and the debt itself is denominated in Pinto. So Pinto, the protocol, has an interest rate that says for every Pinto you lend to the protocol, you will get back some multiplier on that Pinto denominated in Pinto. So the other element of anti-reflexivity comes from the fact that if I'm buying at 60 cents and now I lend the Pinto to the protocol, I think right now you can get like an 11 or a 12x for lending to the protocol. For every Pinto that you buy at 60 cents, you get back 12 Pinto at some point in the future, assuming the protocol grows sufficiently to pay you back. But when you get paid back, you're getting paid back when the Pinto price is at $1. So you not only get this 12x that the protocol is paying you, you also get this multiplier from 60 cents to $1, which is over 50% of a bonus. So it's like the protocol is only paying out 12x, but the lender is getting like, call it a 60% bonus on the 12x. So the protocol is only paying 12x, but you as a borrower get like a 20x. So this is a very interesting anti-reflexive element of the system, which is not talked about nearly enough from my perspective.
Interesting. I'd like to talk about kind of like where Pinto sits right now. So the current market cap is about $6.7 million. About how much like debt is being issued per day right now? How do you calculate the interest rate on the debt being issued? How many dollars in debt is outstanding? Like, can we talk about some of these numbers in the current system right now?
Most certainly. So the best place to get all this information is on pinto.money. There's a data tab where all this information is accessible. In particular, we don't have to get into the terms. On the website, there's a lot of Pinto-specific terminology. This comes from the fact that like the debt isn't a bond in the traditional sense, so we introduce Pinto-specific terms and have our own lexicon to communicate these are not like anything that has existed before it. So I will try not to use the terms just to keep the discussion high level for now. So there are 32 million and a half outstanding Pintos to be repaid in the future. And the way the system works is when you lend to the protocol, you get back these IOUs and you go to the back of the line. So basically half of all Pintos that are minted get used to pay back this debt. And at 32.5 million Pinto IOUs, with roughly half of the newly minted Pinto going to paying off this debt, you basically double the length of the line. From 32.5, you get to 65. And basically the bet that the marginal lender right now to the system is making is that eventually the supply of Pinto will increase by 65 million Pinto in order to repay back that marginal lender. So at a $6.5 million market cap or so, the bet that's being made is roughly that the value of the protocol will 10x, or slightly more than 10x. And the interest rate received for lending Pinto to the system right now is just about 1,200%. So for every Pinto that a marginal lender lends to the system, they would get back 13 Pinto IOUs to be paid back when the system basically 10x's. So, on the one hand, you could say, well, a 12x return is tremendous. How could that possibly be sustainable? On the other end, it's like, well, these previous iterations of algo stables have grown to well over 65 million or so, or on the order of 65 million to hundreds of million, such that if Pinto really is the best attempt yet at solving this problem, it seems pretty reasonable that it could reach that supply and that size eventually. So if I'm willing to take that bet now, I get a 13x from the protocol with like a 60% bonus. So I'm going to get something like a 20x return for betting that the protocol is going to grow 10x. That's the current math on that side of the system. You had a couple other questions on this front. Happy to go into how the interest rate is set, how many people are lending to the system. You tell me.
Sure. Before we get into that, you mentioned that this is not the first iteration of this kind of idea. And Beantock existed previously. It was kind of a protocol that evolved for various reasons. I'd like to talk about what's different between Beantock for those who are familiar and Pinto.
Well, so much is the punchline. So to give a little background, Pinto is not my first rodeo. I have been actively working on previously solving the algo stable problem, now solving the low volatility money problem. This is year 5 for me. So
That's
it is crazy. I am a deep believer in the most fundamental way that in order for a crypto economy to outcompete the traditional economy, we need a trustless, censorship-resistant, permissionless, low volatility money. That is a conviction I have through and through, and I am such a believer in the potential for this technology to change the world in a positive way. I am in year 5 of trying to solve this problem. I feel like both due to my experience trying to solve the problem and my background and my interest, we're doing the best that we can and feel like this is a problem that is worth trying our best to solve because of its importance. And so Beantock was and I had a couple co-founders, so I definitely can't say it was all me by any stretch. But it was certainly my first attempt at solving the algo stable problem. And there's, like, from a model perspective, the model has come so far, but I think even more than, and we can get as deep into the weeds on all the specific features that have been upgraded and how the system is different. But maybe the biggest way that it is different is when Beantock was launched originally. We'd worked on it for 9 months in stealth. We launched it anonymously, but we really put everything that we could think of to make the system, to make the algorithm work as well as we could think of, was put in place with some rare exceptions just because of complexity and building in the EVM. But we really did everything we could to make the system as good as we could. And we took into account all the learnings from ESD and its descendants, which were the predecessors to Beantock. But speaking perfectly candidly, Jack, the Beantock that was deployed in August of 2021, crazy to say that, sucked and was really far away from solving the problem. Mm-hmm. And the result was that as much as it was the best we could come up with without trying it out in the world, the result was that the protocol took on a tremendous amount of baggage in the form of excess debt, which ultimately set things back tremendously. So we go back to this discussion in this trade-off space we were talking about before, which is Pinto is actively making the trade-off to not issue too much debt and to not issue too much debt at too high of an interest rate in the interest of long-term sustainability. Beanstock was founded with the same thesis, but the ways in which it went about doing it were significantly less refined. So this resulted in both its willingness to borrow way more from the market than it necessarily should have been willing to or needed to borrow, and also doing it at an interest rate that was too high. And the way that it was changing its interest rate was too aggressive. And so you had this two separate, multiplying factors, issuing too much debt and issuing too much debt at too high of an interest rate, that ultimately caused the system to take on a tremendous amount of debt in its first 6-7 months, if you will. And so Pinto was deployed in November. It's coming on about 5 months of being alive. It's at like 4.5 months. And I use the word alive dangerously. But at this point, the protocol has issued dramatically less debt and has paid a much better interest rate to issue that debt. When the price was too high and the protocol was growing, it also minted significantly less new supply, which I think has also led to a significantly less volatile downside. Like in Beanstock's first growth cycle, or pump and dump if you want to be cynical about it, because it really was. Like, it went viral on Twitter, and it was pumped, and then it was dumped. The price went as high as $4, and then within a couple days collapsed to 24 cents. And in Pinto's case, the price, except for like immediately upon deployment when there was no supply, and so you had like sort of like not great data, not accurate data being collected, with Pinto, the price has never really gone above, call it $1.20. And right now the price is at 60 cents, which is effectively its low, but it didn't go down to 60 cents in a day or in 2 days. This has been like over the course of months, the price has slowly come down to 60 cents. It's a dramatically different experience than the Beanstock experience. And so happy to get into all of, and we could do hours and hours of content on all of the different, and we are doing some of that content ourselves in the Pinto Discord. We're starting to record a lot of that content for people to have a library to come and try to understand what is going on here, because it's so complicated. It's a beautiful experiment. But I think at least for now, it's probably enough to say that Pinto has the benefit of, so in Beanstock's first 9 months, Beanstock was famously hacked, which in many ways sort of killed the experiment, which is a trauma many of us have still not entirely gotten over. Just when the system started to work, from my perspective, just when it started to pay off that debt, even though it had issued way too much debt, just when it started to pay off its debt and deleverage and start to work, demonstrate a proof of concept, it was hacked and the whole thing kind of blew up. In those first 9 months, because the version that we initially deployed kind of sucked and had so many problems, for those first 9 months, we were putting out upgrades on average like every 2 weeks. There were so many fires to put out that every 2 weeks there was a new mechanism put in place, or an update to the amount of debt being willing to be issued, or a new peg maintenance mechanism introduced. There were so many things happening in such a short period of time, even though as a result of the system being rolled out in a state where, again, the algorithm wasn't great, the system sort of bore that cost and took on that debt and took on that historical baggage. Pinto has the luxury of inheriting all of those improvements that were made to Beanstock before the hack. There's a long history of development of Beanstock even after the hack, although it was never really able to escape that baggage, both from issuing too much debt in its first 9 months and then being hacked. It was just too much for the protocol, for the algorithm to sustain itself. But Pinto sort of has the best of both worlds. One, it has all of the learnings and all of the updated software, there's also been a lot of new mechanisms updated in Pinto itself, like taking the Beanstock thing, taking it way further, taking the algorithm much deeper. But then there's also the added benefit that Pinto did not inherit the debt of Beanstock. So from a sustainability perspective, there was also a clean slate that has allowed Pinto to sort of do its thing and for the model to just run itself from a clean state. So I know I didn't speak super substantively there about like all of the different knobs that have either been created or have been turned such that Pinto in practice is different than Beanstock. Yeah, I think that might be a whole separate, I know we've been going almost an hour already, so I feel like that's a whole other can of worms. But high level, it's like the system has all of Beanstock's improvements, it has more improvements, and then it also has like none of the baggage of having been rolled out in such an infantile state.
I know Beanstock had a strong strong kind of focus on immutability and these like crypto ideals, which may have kind of led to its downfall ultimately. What is your guys' attitude on that, and how do you think about kind of the ability to modify and adjust parameters?
Well, first to highlight the problem that Beanstock faced in practice, because you're totally right, our commitment to the values, and I wouldn't say it's immutability, but like decentralization, trustlessness, permissionlessness, these are a lot of the values that make Bitcoin what it is and make like Ethereum what it is. And we feel like in order to fill that low volatility money use case, the goal is to make the system as deeply aligned with those values as possible. And quite tragically, we thought we were solving an economics problem with Beanstock. And to the point that the system did start to deleverage, and obviously we're still here working on it, we feel like there was enough data there that we've done a decent job at solving the economics problem, or have done enough to continue to justify continuing to work on that. But where we had a blind spot was we didn't realize there was actually a second problem that has to be solved, and that's a governance problem, where Bitcoin obviously has its own consensus system and proof of work that codifies governance explicitly and implicitly. Obviously, like Bitcoin governance is a whole sophisticated topic, but it's defined by the system itself. In the case of Beanstock, where it was a system of smart contracts that was deployed on Ethereum, where Ethereum now has consensus, basically the governance of Beanstock was run by these smart contracts. And smart contract governance looks totally different than governance by consensus, by a validator set. And so Beanstock, the hack, it wasn't an economic hack, it wasn't a bug in the code, it was a design flaw around the governance mechanism, where someone was able to come in and hijack the governance and pass a vote to send them all of the money in the system. So this was deeply traumatic in the sense of, we thought we were solving one problem. We thought we were actually doing a pretty good job at solving that problem. And then a whole nother problem that was not on our minds, or not top of minds at all, ended up being the unwinding of that system. That was very painful. So with Pinto, we've taken a bit of a different approach. And it's worth saying, like immutability, which you highlighted, is definitely the goal. But for software like this, where the algorithm has a lot of work to do and needs to be refined significantly in order to get to a place where it can just be hands off entirely and the algorithm will just run itself forever, we're a long way away from that. And so there does need to be some mechanism in place to allow for the upgrading of the algorithm. This is the current state that we find ourselves in, where we still need the ability to upgrade the system. The totally permissionless and decentralized way to do it was hacked, and there has yet to be a compelling, equivalently permissionless and decentralized way to do governance. And so here's the current model for Pinto. It's sort of two parts. One, up until the protocol hits a $500 million market cap, and for a period of time, I think it's a couple weeks after that, the parameters of the system can continue to be changed. And This is governed by a multi-sig, where the parameters are not just like changing a 1 to a 2 or something like that, but the system, if you think of like the state space of the system, like how much debt to issue, is governed by an algorithm. So you can think of like the whole system as an algorithmic system, but each of the components of the system, it's pretty composable. There's like an algorithm devoted to this, an algorithm devoted to setting the interest rate, an algorithm devoted to setting the amount of debt the protocol is willing to issue, and so on and so forth. And so for each of these algorithms, the multi-sig is able to basically upgrade the algorithm to change the parameter, if you will, the effective parameter that the system is creating or manifesting on the chain itself. Those can continue to be changed effectively arbitrarily up until 500 million. And I would say this sucks compared to the governance of Beantock from the perspective of every one of those Beantock governance changes was like a contested vote. There was a tremendous amount of public discussion about it. That was super aligned with the development ethos of our space. And we are trying with Pinto to communicate at a similar level, but of course without having a vote to implement each of these changes, it's not the same thing. And we want to be as transparent about that as possible. Right. Now, the question then becomes, okay, like this is until 500 million. What happens at 500 million? What if the algorithm is not at a place yet where, you know, people feel like it can just run itself forever, hands off? What happens then? So this is now where a lot of thinking, a tremendous amount of thinking has gone into trying to create a new system with the best of both worlds, where you have permissionlessness in terms of the ability to innovate. Like that's another thing right now. Only the multi-sig can even propose changes, really. Obviously, you can come talk to the people that custody the multi-sig, but that's not even close to the permissionless governance that Beantock had. So there's an open question how to create the optimal system where the protocol can continue to iterate. There's permissionlessness with respect to governance, but the risk that Beantock realized, which is that the governance system was hacked, where the code was changed out from under people in a malicious way, how can that also be removed? So this is where the thesis is that the best way to do this is some sort of emulation of validator-based consensus. It's not a one-to-one, but basically to try to create a new type of smart contract governance, which we are calling temporarily, it's still a work in progress on the naming front, but fork-based governance, where basically we envision making it super low friction for anyone to deploy a fork, and I put fork in quotes because it's not exactly what people are necessarily thinking, where anyone can basically copy the state of Pinto, copy the code base, make changes to it, and then offer all of the participants of Pinto the opportunity to migrate to the new code base. So this sort of is a middle path where on the one hand now anyone can do it, it's pretty low friction, anyone can propose upgrades, but I as a user am not exposed to risk here in the sense that the system that I am currently using, the code that I'm running, if you will, the code that my money is running, is never going to change out from under me. So I at any point can choose to upgrade to the latest code. I can even subscribe and say, hey, I know Jack follows Pinto pretty closely. I just want to run, and there's a network effect here. I just want to run whatever version of the code Jack is running. So I subscribe to Jack. Or I could subscribe to Jack or Ben, that if Jack or Ben moves to a new system, I'm going to move with them. So there's this really interesting new properties that are here in this new type of governance system, which we're calling like fork-based governance, that this is one of the things we're working on implementing right now in Pinto. So right now we still have the multi-sig, but in the hopefully not too distant future, we'll have this fork-based governance, which is really powerful.
That's a wild concept and something that we could also, spend hours on, I bet.
You might have to have me back.
I have one final question, and it's what is your like ultimate vision, the biggest ambition, or kind of like the terminal state of what this project looks like?
There should be trillions of Pinto. Volatility should be measured in basis points, with the exception of the occasional black swan, in which case volatility will still be measured in single or double digit percent, but that's all part of the game, if you will. And Pinto, or one of its derivative forks, which may still be called Pinto, or depending on how the social consensus around the names come with each fork, it may be Garbanzo or something like that. But one of the derivatives, and one of the cool things, not to digress too much back to the fork thing, it's like with each fork, the fork can have rules to honor the entire state of the previous system. So it's not like, oh, when I move from Pinto to Garbanzo, or I move from Pinto and upgrade the software, I lose any value. It's just upgrading to a new model, if you will. So It's not like people are getting forked away. They just get to upgrade to the new software. My vision is that there will be trillions of Pinto, and that it will be the base currency for the crypto economy. So it will replace USDC and USDT, both as a payment rail for people to just send value, but much more powerfully, it will replace USDC and USDT as a medium of exchange, which is, right now those two assets are the primary value providing liquidity for all different crypto assets. Even you look at like meme coins and stuff, like liquidity is still centralized for those assets. This all sucks. So we believe we've created a better currency, and our vision is that Pinto will fulfill the medium of exchange and unit of account use cases of money and complement Bitcoin, which is the best store of value we have, to actually enable this crypto economy.
Phenomenal. Where can people find you?
Pinto.money is the URL where you can access the system and learn more about it. Would encourage people to come hang out in the Discord, come ask questions, come pick our brains, come share your FUD. The only way that the system is really going to work is if it becomes resilient to all sorts of FUD and problems. And so the more people that come and just ask questions and share what they're concerned about and what they don't understand, the more this thing will be able to happen. So come check it out. Come hang around with us. We think what we're building is as cool as it gets, and the more people that come and ask us hard questions, the better.
Ben, you've opened a whole can of worms for us here. So thanks for coming and chatting about Pinto. We're looking forward to seeing what you can do in the future.